Hello, hello, everyone. Welcome to episode 31, right? 31?
30.
30. Oh, my God. 30?
Yep.
Episode 30 of the Stock Talk with Josh and Nico. And you already know who this is. This is Josh and Nico. Nico, how you doing today?
Fantastic.
I'm ready to get started with this episode.
Me too. I'm ready.
So let's just get started with our guest for episode 30, AJ Moran. AJ, how you doing today?
I'm well, thank you guys.
No problem, no problem. Now, can you give us and the audience a little bit more, a better introduction?
Sure. I'm AJ, right? I wear a few different hats. You guys know me from here at Purdue Northwest. I'm on faculty in the College of Business. So I teach some finance work, some organizational behavior. I'm in the entrepreneurship program, so I work with a lot of our entrepreneurial clients as well as our students, specifically on the finance side. And then I have a financial securities position in Chicago where I manage stocks and bonds for clients. I also practice manage other advisors' practices. So I have a team of advisors. We work together to manage clients' assets. These are retail assets, as we say. These aren't institutional. These are retail. So these are humans, individuals, trusts, charities, trustees, things like that. And then I live here in Northwest Indiana. I have a farm. I'm a farm owner operator. I'm in the ag space here in Northwest Indiana. I have some responsibilities for an ag tech startup as well here in Northwest Indiana. So I have my hands in a number of things on any given day.
Yeah, you said a lot of stuff, but the most interesting thing to me was the farm. So how long have you had the farm?
That's the most interesting. So I've had this farm. We moved there in 14, 15. So I have an equestrian facility over by the other campus in Westville. We teach riding. We also do some equine assisted learning work. So we work with families, kids, adults, corporate groups to introduce them to horses and to help them understand what horses can teach us.
Very cool.
Yeah, I'm going to have to get the address to your farm for later on.
Yeah, come on over.
But we were having a conversation about bonds,
Yes.
So you say you during your daily basis, you work with bonds and teach people how to do bonds, things like that?
Sure.
So give the audience a little bit more of the description of actually how does bonds go to your daily work process?
Yeah, so when you think about the market, most people talk about stocks, right?
Yeah.
Well, that's actually the smaller part of the market. The larger part of the market is actually what we call the fixed income market, bonds, right? So you can have money that is based on the growth of a company, right? If they grow, you can, cash that out to somebody else. If they don't grow, you can lose money, right? Bonds are a completely different animal. Bonds are, I need to build a stadium. I need to build a hospital. I need to build a university. I need to be able to pay the bills as the U.S. government has to pay the bills for the Department of Defense, right? So I'm going to borrow money, and I'm going to give you interest every year on a promise that I'll pay you back in X amount of years. And so typically 30 years is typically what you think of as a 30-year bond or we'll just call it 30 years to be simple. It is borrowed money that then you can build a hospital with. You can go ahead and fund the Department of Defense with. You can build your roads with. It's a promise from typically large companies, what we call municipalities, so county, city, states, and the federal government. Other countries also issue bonds. It's an IOU to raise money for your balance sheet.
Yeah.
Okay. You and I, regular human beings, we interact with bonds most often in the space of a mortgage. That's being a borrower, right? And we package those and we sell those out to the market, but that's being a borrower, right? And it is how insurance companies fund their business. It is how large corporations fund their day-to-day operations. It is the backbone of our economy. And if you actually want to go back, for any of you musical fans out there who have seen Hamilton or who understand Alexander Hamilton, this was his whole proposal. This is why him and Jefferson were arguing, right? His whole proposal was, I can grow wealth faster if I let you borrow money for a house. Here's $500,000 in today's, right? Because you can't write a check for $500,000, but you're good for it over 30 years. This is how we created wealth in this country, is being able to issue credit, right? So that's why this market is so big. It is not sexy. We talk in basis points. We talk in small percentage movements. When interest rates change, it is a monumentous issue in my industry, even moving 25 bips. You've seen what 50 bips have done over the past few weeks. This is, though, the backbone of how you get roads, how you get houses, how you fund your Department of Defense, how you fund your police.
Okay. But so say if the interest rates go down, would it be like a positive or a negative effect
For who?
on bonds? Yeah. Yeah, I guess
For
you gotta
who,
say,
right?
Yeah.
So it's all interrelated, right? It's complicated, but there's some straight lines here. So interest rates are essentially, when you think about interest rates, let's just think about it like this, is a spigot, right? It is the top part of the sink that you turn on or turn off, okay? When you want there to be more money in the economy, you make money cheap and you turn on the spigot. When you want less money in the economy, for a number of reasons, right? Most recently, it's inflation. When you want less money, you turn the faucet off. You make it more expensive to have money. And it is a very, very blunt hammer that the Fed has. And the important thing, too, I always tell my students this, is the Fed doesn't set the 10-year Treasury. The Fed doesn't set credit cards. The only rate that the Fed sets is the overnight lending rate to banks so they can balance their books overnight. And this goes back into the olden times with ledgers and pencils and the Federal Reserve banks, where you'd have to go and give the Federal Reserve in Chicago your bank data for that day. And if you were short some, you had to borrow overnight. And if you weren't, you were fine, right? So that's a very blunt tool that the Fed uses to set the overnight rate. There is where the piggybacks happen in the market. The 10-year Treasury that we were talking about a little bit ago, you can actually go on and watch the auction. The Fed doesn't set that. The public sets that.
The market decides
Yeah, based on where the overnight is, right? So in a typical yield curve, shorter-term bonds will pay less interest. Longer-term bonds will pay more interest. That's your typical yield curve. We spent a lot of this year not in a typical yield curve, so it doesn't always have a curve like that. Sometimes it's straight, sometimes it's inverted. It was inverted a while ago, is what we call it, when the longer term rates are shorter. Go ahead.
And when it inverts, they say normally it's when a recession comes within the next year or two.
Sometimes, yeah. Sometimes in some quarters after that. Correct.
Right.
Yes. There's a definite correlation between those two. Yep.
Yeah.
Yep.
And we had one in 2019, and then we happened to get one in 2020, but because of COVID.
Correct. It was a weirdo.
Yeah.
It was a weirdo one. Yep.
And it also inverted a couple months ago.
Correct. Yep.
And so, I don't know, that another reason to believe that we'll have a recession later this year. But
yeah, possibly. Yeah.
We'll see though.
So do you think a recession would be possible too?
It's possible. Yeah. Absolutely. There's some really ugly headwinds.
What do you think the chances are that we have one this year?
You don't know you're in a recession until typically you're in the middle of it or on the other side of it.
Yeah.
Different than a depression. You know when you're you know, right? The market's a leading indicator to that. So if the market is a leading indicator to that, this summer will be very interesting, right? There's no way to know. There's too many variables to know. So that's why we give things percentages. That's why we give things, probabilities, right? It makes us feel like we can control the information.
And
Who
so
knows?
the main thing we're looking for here is that we have at least two quarters back to back of negative GDP growth, right? And so we've had Q1 of this year negative, and then so now we're just waiting to see if Q2 is going to be negative, right?
Yeah, we'll see.
And so,
We'll see.
Well, I personally think like some sectors will probably go up a little bit more because with COVID being a little bit over, more people are going to try to spend their money more. So more money going in out of the economy. That's just my thinking. Because like say cruises. People weren't going on cruises 2 years ago.
No.
That's one industry like the travel industry. That should go up.
I got on an airplane a few times this year, and I hadn't been on an airplane in 2 years.
right.
Yeah, and I'm buying my things, my snacks, and I'm doing the rental car, and yeah, absolutely.
Yeah, so
doing the fishing, yeah.
Even with the prices going up, people are actually still buying it for buying things too.
Well, we talked about this earlier. Wages are up.
Yeah.
Wages are up significantly in some places. So there's money. There's absolutely money. Things are more expensive. And when things get more expensive, people get pickier about what they buy. And we talked about this earlier too. If wages are up, 10%, that's great. But if you're making $30,000 a year, right? And your wages went up 10% and now you're making 33, is that really as impactful, right? From an economic perspective, because you might still be struggling, right? Different than somebody who's making, 300,000 and they get, a 10% raise and now, they're starting to, it's different, right? It's different for everybody. There's a lot of moving variables there. And when you're talking about the price of gas, when you're talking about the price of chicken, when you're talking about the price of anything you can find in the grocery store, those are all common denominators, whether you're making $30,000 a year or $300,000 a year. We all have to go get groceries, right? And that is more impactful negatively on the $30,000 person or household than the $300,000 household.
Right. So one of the things I wanted to bring up today was what do you think the chances are that we have let's say a 1 month or a 2 month rally in the stock market for this, let's say this summer or this fall?
Sure. So the math suggests that it's possible too, right? There's absolutely, there's historical evidence when you look at the S&P's 50-week moving average and how ugly it's been. Yes, there should be, right? However, God forbid something else happens in the world and you don't know, right? But mathematically where we're at, yes, there's usually a rally. We'll see. There's also what we call, and I don't know if you guys know this term, but we use the term a dead cat bounce. Have you ever heard that before?
I might have, yeah.
No, I don't think so.
It's exactly as sad as you think. Dead cats still bounce when they've come down 20%.
Yeah.
So you get we call them dead cat bounces, where you get these days in the market and these weeks that look absolutely gorgeous, but it's just volatility and froth. It's not.
Right. And
dead cats still bounce.
See, the other day I was looking at the chart for the stock market in 2008 when it crashed.
Yep.
And even though it crashed for, over a year, it still had, along the way, it had, I want to say, at least 4 or 5 short-term bounces of.
And that's a very different market than this. This is not that.
Yeah.
This is not that. Things are different. But what happened in 2008, I share this with my students all the time, and we get farther and farther away. They don't, they're young enough that they don't remember. There were some very scary nights in 2008 in the fall where I remember watching, the CNBC on a Sunday night, realizing that a lot of my friends' firms were not going to be
survive
open in the morning.
Oh,
yeah.
okay.
No,
okay.
they were going to have, there was going to, it became very clear that Sunday night, and as emails were coming in, we were concerned about there being enough cash in ATMs. It was that scary, right? This is not that, right? This is not that. That was a fixed income disaster. Our fixed income right now, they're raising interest rates, right? So, and is there a bubble somewhere? Sure, there's always a bubble somewhere. But it's not that. But yes, you see these bounces that come up. Summer's typically kind of ugly volatile because people are on vacation. They're not, they're not paying attention. They aren't trading. Traders aren't trading as much. This is when people, to take Memorial Day to Labor Day is typically not that exciting. It's usually kind of ugly because
and you also normally have sell in May and go away.
Yeah,
type of thing.
exactly. So take that with a grain of salt with summer, right? But we'll see. When you look at the 50-week moving average of the S&P 500, you see some definite room for upside in here. You see companies with strong balance sheets who just got hammered in their Q1 earnings that now have significant value available to investors, right? And if you understand that company and you like that company and you like that business model and you like their revenue streams, there are some very, very serious buying opportunities if you have cash on the side right now. And I think you'll see that start
some
to
grad
happen.
party money coming.
Correct.
Yeah, right.
Yep. You get some party money and you just go and yep. You can do that. But I think there's absolutely some opportunities to be had right now, especially if you're going to be patient. I think there's some very large opportunities to be had.
Yeah, I was even telling him. I told him look at all the big companies like Apple, Disney, even Amazon. They're all down now.
All on sale. I love buying things on sale.
Yeah.
I'll go to a store because something's on sale, right?
Got to have a coupon.
I'll take a coupon. Not a problem.
Okay, yeah, but this is a great conversation we have here on the Stock Talk. Real quick, we're going to take a quick break, so don't go anywhere here on Stock Talk with Josh and Nico. All right, we are back here on the Stock Talk with Josh and Nico. We are once again joined by our guest, AJ, and we were having a great conversation, and we're going to be continuing this with asking AJ a question. Now, AJ, our question is, where is the money? Meaning, where is all this money going?
Which money?
So the money I was talking about was the money that was printed by the Fed over the last couple of years, whether it's to the corporations or to regular Americans. There was trillions of dollars, whether it was 5 trillion or 7 trillion, whatever the number is. A lot of that money got pumped into the stock market, right? And that's what pushed up stocks a lot. So, but now that the stocks are selling off, I'm kind of wondering, where is all that money at now?
I know. And you're going to want a straight line answer, and it's not, right? And so here, let me give you some examples of where the money is. For example, if inflation is up 10% as a number, right, and you printed $1 trillion, then that's actually only $900 billion in today, right?
Yeah.
It didn't go anywhere. It's still the same dollar bill, right?
It's just worth less.
It's just worth less, right?
Yeah.
So that's a piece of it, right? One piece. Here's another piece. All this money got pushed to humans, right? Buying, or not buying, excuse me. They got these government checks, right? Government checks. They went and bought stuff with it, right? That went to Amazon. That went to the gas station. That went to the grocery store. That went to
Local places, too.
Yeah, and cruises. I mean, so it went to those companies, right? It also went to people's savings accounts. They paid off credit cards, so when you pay off a credit card, that money, the interest goes away from that company, and you paid off something that you bought before.
Yeah,
right. It's borrowed money, right?
Yeah.
So again,
so they paid
it's
off debt.
Funny money.
Yeah,
it's funny money. It's not a straight line. When companies got money and they started doing what we call share buybacks, right? So okay, well, I want to get some of my shares off the street and boost our balance sheet. Or excuse me, our balance sheet. Well, all of their values have decreased. So all of that money that they have the shares, but it's not worth the same value, right? So when you fall and it's very difficult to follow a dollar bill through the economy because it's difficult from an inflationary perspective. It's difficult from an interest rate perspective. It's difficult also because when you're talking about the difference between paying off debt, buying shares, those values change, right? So it's there. It fueled inflation. It absolutely fueled inflation, which gets us to where we're at now, right? Because your supply and demand curve starts to rise, right? Because people have more money, right? And you're able to buy more stuff. So that's part of where you get inflation. But now your money's worth less, right? So it's hard to follow the money. The other thing to remember, too, is that anytime the government prints money and the economy does well, they also collect that in taxes. And that's not just the federal government. That's also your state government. Yes, that's your sales tax. That's your, as housing prices have risen, property taxes have risen, right? So all of the entities that also provide us service and structure also benefit from it. But it was spent, for the most part. A lot of that valuation that was spent has decreased, but it was spent.
So now let's say whether we're talking about an average person or like the hedge funds that own stocks, the past couple of weeks they continuously sell, and a lot of them have probably been selling at a loss a lot of times, right? Because
depends on when they bought it,
right?
I mean,
but if you bought any time from 2020 to,
you're still up in a lot of stuff.
You think so?
Yeah, he probably
I don't
still
think
up,
so.
yeah.
In a lot of them, they're
I know
below.
so.
In a lot of stocks, it's below the 2020, even 2019 levels.
But a lot aren't.
Okay.
Yeah, a lot aren't. A lot of your tech is, right?
Yeah.
A lot of your tech got slaughtered. Certain industries got slaughtered, but no.
Some of them are only at a 1-year low or a 2-year low, maybe. So people could still be up.
Correct.
Right.
Correct.
But so let's say the people or the hedge funds that have been selling. Do you think they're just holding that money in cash right now, and they're just saying the economy is too dangerous, we're not sure, and so we're just going to hold it in cash?
Yeah, so it's not just cash. They're taking advantage of higher interest rates. So they're offering, they're trying to get lending happening from, right? So they can take advantage of higher interest rates. This is where you start to see the shift go from anytime the 10-year yield goes above the average S&P 500 dividend, you see people you see institutions very interested in debt instruments, right? And so what has the highest interest rates? Credit cards, student loans, cars, second houses, boats, motorhomes. You see a lot of money start then. You see loan packages starting and loan facilities starting. You also, in this type of volatility, there's significant money to be made in options. There's significant money to be made in special purpose vehicles. There's some very, very complex math product you can use to make very, very serious money when you have a lot of money. In volatility. So you're seeing a lot of that right now too. Volatility feeds volatility, and there's money to be made in volatility.
Right. See, one of the interesting things that I've looked up before was, even though it makes sense for when the Fed raises rates that it should hurt the stock market because it's going to hurt companies their finances, it looks like the stocks actually go up after the Fed raises rates, though.
Yeah, because it's not actually hurting. It's painful at the beginning, right? But what it starts to do is it will flush out the good companies, right? It will flush out
the good
who's
and
got,
big,
who's got good balance sheets, who's selling good product, who's providing good service. It will flush it out,
right?
And they absolutely will do. And remember too, they're paying people more now, right? So there's less money from a short-term perspective, but in theory, you should be able to produce more when you're paying people more. I mean, in theory, yes, it should take care of itself.
See, but the interesting thing is, like, even the companies, let's say like the cruises, or let's say a car company, if let's say they don't have the best balance sheet, and we go into some sort of a rough economy, they still will either get a government, they'll get backstopped or whatever it is, and so even it doesn't, if they have a bad balance sheet, they can still survive.
Sure.
Even that's the interesting thing there.
Well, but those are also larger companies, right? Yeah. We're gonna, as a public, we're gonna backstop Ford before we backstop, Billy Joe's new IPO startup.
Yeah, right.
You know, because you're talking about jobs, right? You're talking about, the reason we backstopped in 2008, the insurance companies and the banks. Well, the banks was different. I won't use that example. Excuse me. Let's talk about the cars. The reason we backstopped the cars was we knew people weren't going to be able to afford cars, and did you really want another 200,000 people to lose their job overnight?
Now, why do you say it's different for the banks?
In that situation, it was different. We had to backstop the banks because what the banks had done and the investment firms had done was they had all these, exotic fixed income instruments they were using. The problem was that they all made money insuring them against each other.
Oh, yeah.
And so from an insurance perspective, let's say you're MetLife, as an example, and you have, 4 million people have life insurance policies with you, and all 4 million of those people die at the same time. You can't pay it.
You can't pay
That's what happened. There wasn't enough money to pay all the bets against. There literally was not enough money.
Right.
And it froze the system. That's why you had a frozen system. So that's why I said it's different. It's a totally different thing than us. We didn't want, from a car company perspective, to lose all those jobs.
Now, do you think something like that could happen today?
Sure. Why not?
Do you think it could still happen?
There's always a bubble, right? Hindsight's 20/20. Right? Who knows? Bubbles are created all the time. You don't know until they burst. That's why they're called a bubble.
Right.
Yeah. Well, like how you talking about with cars now. Cars, the prices of just.
I was talking about 2008 when we
2008
backstopped.
cars.
Yep.
Now, like coming to now with used cars, the prices are going up and up and up.
I know.
How do you see that like somehow correcting itself?
That'll correct itself once the supply chain corrects itself. Once semiconductors are more of it was simply there wasn't the supply to make it. And then if you have your whole factory sick with COVID, you have no semiconductors and everybody's home sick for the month, right? I can't make stuff, right? That's what you saw happen. So as the supply chain continues to ease itself, and we're still going to have problems, right? Like Shanghai, Lord have mercy, those poor people in Shanghai, they're 22 million people, locked in their houses because they're not. That's a supply chain issue for us as well, right? So once the supply chain continues to unloosen, there won't be this need for used cars. You'll be able to go and you'll be able to find a used car. You'll be able to find a new car.
And that's what's weird. It's taking so long. All the companies keep saying it's going to be till 2024 until the chip shortage ends.
They keep pushing it back. It feels
Sure.
like
They keep pushing it back, yeah.
Yeah.
And it's like, as long as people get back to work, then you would think that would correct sooner, right? It shouldn't take years to...
Well, there's still places in the world like Shanghai where 22 million people aren't working right now.
Yeah, that's true.
Right? That's a lot of people in a tech center, in a finance center, in a manufacturing center. We don't have enough ships. Our ports aren't big enough. And if you're coming from a country or leaving a country where there's a COVID challenge, you don't have a crew. And we're all sitting at home here in the United States and Europe with tons of money in our pockets buying crap.
Right. So demand is through the roof.
man.
But so the people in China, they're still not back to work?
No.
Oh.
No. There's pockets in China that, and it's not cutesy like you and I can wear a mask and go to work. It's you're going to be in your house for the month. Yeah.
Okay. Well, see, what the other thing I wanted to bring up was that when we were talking about the interest rates, this is one of the only times. So this chart goes back to 1955.
Okay.
This is one of the only times when the interest rates have been zero. So
correct.
Traditionally in the past, it's only it goes up to 2%, 3%, and so that's what makes this situation so much different.
No.
Why not?
It's because you're young. When I was little, interest rates 10 to 20%.
Oh, okay.
Okay.
Right.
So I tell my students this all the time, and they just look at me. We've been in historically low interest rates your whole life, and that really changed after the dot-com bubble. So we had a very large stock market crash in 2000, 2001, where anybody who created a website got billions of dollars of IPO money, and there was no businesses behind it. It's not funny. It was a bubble. So we've been at historically low interest rates for 20 years.
Yeah.
And this is back to your question, why do people buy bonds?
Okay.
Right?
Okay.
Yeah.
And I'll give you an example from me. My grandpa died when I was little. I don't know, 10, 11, 12. I don't know, little, right? I got $5,000. Okay? And my dad said, you're not allowed to spend it. Dad's right. So he gave me a Wall Street Journal and said, you go find a CD, you send that check to a bank, you find a 5-year CD. Okay. So I don't know how old I must have been like 12 or so, right? Because I remember getting the check back at the end of high school. So call it 12, right? I take a Wall Street Journal, look at the 5-year CDs, Key Bank, New York, 8%, 9%. I don't remember what it was, but send them my check, and then forget about it. And 5 years later, I got $9,000 back, right? That's the power of interest rates. No risk, federally backed. You give them your principal, you lend them money, and they pay you back, right? Now I'm the lender. And that's the beauty of bonds. You haven't seen it in your lifetime, right? When we do modeling, when we do modern portfolio theory modeling over 100 years, bonds are a critical part of lowering volatility. Bonds typically go up when stocks go down. You haven't seen that in your lifetime. But that's the math of it. That's the math of it.
Okay. Because I guess
promise.
compared to like I compare it to like if you got, let's say you made a group of stocks, let's say you bought an index fund or something of just some really low volatility stocks that paid at least, let's say, a 3% dividend, something like that. Let's say you bought Home Depot and Costco and Walgreens and a bunch of safe companies, and you would think that would outperform bonds by a lot then.
Not if they were all coming due on Friday.
What do you
Market's
mean?
down 20%, right? Right? It depends, right? So bonds typically with a equity portfolio had decreased volatility and increased the safety of the entire bucket regardless of time frame.
It's more consistent compared to that.
Less highs, less lows.
Okay.
I'm not saying you have to do that, right? And if you're young, I see no reason for you to have bonds for long-term purposes, right? I absolutely agree with you. You should have a portfolio of stocks because you can weather 30, 40, 50 years.
Yeah.
But if you can only weather 2 because you're retiring,
I see.
anybody who's retiring, I have them in bonds right now because they need the income.
Mm-hmm.
I can't have them taking income off of a 30% down portfolio.
Right. Yeah, that makes sense. Okay, I have another question.
Okay.
So
Well, we're real quick. We're gonna take a real quick
Okay.
break, and then we're gonna get back to questions.
Okay.
But
Okay.
once again, come back here for Stock Talk with Josh and Nico. All right, we are back. We are back here with Stock Talk with Josh and Nico. So we're gonna be continuing this conversation with oil and gas sector. So we do know you're like in all different types of sectors all over
Yes.
the stock market. So how do you think the oil and gas sector is going right now?
Well, it's great, right? It's great. You took a significant producer of barrels of oil offline for Europe. And so when that happens, you have the price of oil increase, right?
Mm-hmm.
And OPEC decided they weren't going to increase output to help anybody, right? So you get everybody makes money. You and I pay more for gas.
See, I saw something that I was looking at a chart that had the number of oil rigs over the past year, and it's like way up there. So that would make you think that oil prices should start coming down soon.
Yeah. So when you talk about oil, you have to remember that there is a group called OPEC who sets the price and who sets production, right? It's not us. It's not everybody. It is not a capitalist system.
Okay.
So if they decide not to produce more, it doesn't matter how many oil wells there are. Where were the locations of the oil wells you were looking at?
See, so right here it says there was 106. Now there's 480.
Where?
It says in the U.S.
Yeah.
But OPEC still have to say send workers there to even.
Well, and the U.S. is a great example this year. And we were talking about this before, where you heard a few months ago when Russia invaded Ukraine, everybody, I was watching the press conferences from the White House, and a lot of reporters were just hammering, drill more, drill more, drill more.
Mm-hmm.
All of those permits exist.
Mm-hmm.
We can absolutely produce more than we do.
Mm-hmm.
It's not cost effective for the companies to do it.
When they make a ton of money, though?
It costs them a ton of money. It's still cheaper to bring it in from other places. They have to pay for labor. They also have to pay for transportation, right? Midstream there's entire companies devoted to midstream, not just how it gets from the well
Yeah.
to, right here, we're at BP, right? How did it get from the well to here, right? That's the midstream space, right? So it is still, those drilling permits exist in the United States. Nobody wants to use them because it's still cheaper to bring it in from other places in ways that we're already doing it. So when you talk about oil, that is why the energy sector, you took a major producer offline for the U.S. and for Europe. So you pull the player off the table, right off the chessboard, and you have to make that up somewhere, right? It has to either come up in by production, which OPEC said it won't do, or it has to come up in price, which is what it has done.
Mm-hmm. So where are we getting it? Do you know where we're importing it from mostly?
We import, we create our own.
Yeah,
we create our own.
Okay.
We import from South America. We import mostly from the Middle East, right? That's it's a whole
we don't have to talk
dissertation and
about,
a doctorate, a whole doctorate on importing from the Middle East.
that'd be a 2-hour podcast.
Correct. Yes. So that's where we get it from, and they know, the Middle East specifically knows that they don't have to produce more, right? Because we're still paying. The times you see OPEC produce more is when we stop paying. And when do we stop paying? When we don't have money in our pockets. Do we have money in our pockets right now? Yes, we do. So you will pay $5.
So what would make OPEC say we're going to lower the price of oil?
They're not lowering the price. They're lowering the supply, right? It's a supply. They don't set the price.
So what would
the market sets the price.
What would say we're gonna have more
give
supply?
more to the
Increase
world,
the supply.
right? Yeah,
Yeah,
increase the supply. Recessions,
Okay.
depressions,
Okay.
changes in currency.
Okay.
Such what I mean, like change, like say, like
Yeah. So right now, barrels of oil are denominated in dollars. Okay, and that's true for. So everybody who wants to buy oil has to buy that with American dollars, right? If, let's say, the euro were to become significantly more powerful against the dollar than it is now, right? Then it becomes attractive to our dollar's worth less, right? So you can get currency fluctuations inside of OPEC production depending on your biggest buyers of your
Okay.
oil. So
Okay.
and that will change it.
but that all depends on the big buyers, which is our
Yeah,
country.
you've also seen politics change it. If they do something super naughty in the Middle East, all of a sudden they'll produce more as kind of like a
I see.
Yeah. Please stop.
right. So there's also it's the politics of energy, right? OPEC is the politics of energy. It is not just simple supply and demand. It is the world order as it relates to the most powerful sector from a balance sheet perspective on the globe. You're talking about companies here who have bigger balance sheets than most countries when you're talking about oil companies. The only sector that could rival that, and is starting to a bit, is the tech space, right? And so you're seeing it's really fascinating if you want to watch where the money's flowing from a venture capital perspective. Look at the Middle East. Look where the Saudi money's going. Look where the Middle East family sovereign wealth fund money is going. That's the next spot, and it's going to tech. But that's where they're putting their oil money now that they get from us and from Europe and from Russia.
You know what's
and from other places of the world. Yeah.
What's interesting is the only time I've heard that before is in regards to Lucid Motors, that EV company, because that was one of the companies I heard last year they invested a bunch of money in. But I don't know.
So everybody pays them in U.S. dollars, right? And these are royal families. These are not democracies. These are families that are getting paid. And then they have to do something with that money. So they go into these sovereign wealth funds, and that's where you see a lot of the venture capital activity and a lot of the innovation activity right now is those who are writing checks to European intellectual property, to American intellectual property. That's the money flow, because they understand at some point it won't be about oil anymore, right? It will be about other types of energy.
Right.
We can do that now, right? And your broker in between that is the oil companies, right? Who again are incredibly powerful globally, right? They have their own armies. I mean, these are incredibly powerful companies who aren't going to go lightly, right? At some point they will, though, right? And we're going to have other ways we can create energy. And actually, this is an interesting space, and I spend a lot of time researching IPO space around. It's not creating energy that's our challenge. We can create it a whole bunch of different ways. Our challenge is to store it. Batteries suck.
Yeah.
They do.
They don't last long. Yeah.
They don't, or power lines lose in transmission. The best battery you and I know of is our own human bodies, right? We're great at it, right? We eat some stuff, we have some heat, right? We're great at it, right?
Yeah, right.
We haven't solved storage of energy yet. Storage of energy is what gets us off the planet, is what makes us not need fossil fuels. It also takes all of the technology, and that's the problem we have with solar and with wind and with geothermal, is we can't store it. We don't store it well. And that's why Tesla was such a big deal. That was originally why Tesla was such a big deal, is he was going to conquer battery. He hasn't.
But they still use batteries now for
Lithium,
storage.
yeah. Have you watched lithium stocks this past year?
No.
Okay, maybe you should be looking at lithium. Yeah. Lithium is our best and greatest right now. You have to mine it.
So,
it's ugly to make, and it creates significant waste. Significant waste. So
is that why, let's say, let's say Tesla, for example, they're going more into like the renewable energy spaces. Like if you use, let's say you use solar energy, something like that, it would be easier to kind of channel the energy, right? Because it's just coming, it's natural.
Still the same battery. How are you
Oh.
storing it? So the sun goes down.
Then you got to store it someplace.
You have to
Yeah.
store it till the next day. And batteries suck at storage. How often do you have to plug in your phone?
You were just talking about this.
Yeah, before it's gotten dramatically worse. My phone dies
Correct.
like this now.
Correct. So that's what's next, right? So I mean, I understand we're getting off the energy conversation, but
Yeah.
that's what's next. It's storage. Whoever conquers energy storage, it's game over. And the reason it's game over is because we can leave the planet. We can leave. Because right now to leave, you've got to burn fossil fuels to get out of the atmosphere.
And then you got to come back.
Okay, do you know what is oil the most efficient form of energy right now?
I don't know how I don't know the science of how you even judge efficiency, right? Like, I mean, windmills are pretty efficient. There's no friction. They do the jobby thing. But you lose anytime you put a line between two things, whether that's your electricity line between two things, whether that's, from the NIPSCO power generating station to the windmill, you lose 30% in transmission. 30% gone.
Just like that.
That's what you lose. So, clearly the combustible engine has worked for us as humans for, centuries now, right? It's absolutely worked. And that's why these companies are so powerful, is that we've built our entire communities on this. But whoever wins storage, that's
So do you think it'd
the
probably
game changer.
it'd probably be something like it'd still be a battery, just a more efficient form of a battery?
We'll call it a battery,
But
right?
it'll be completely.
Because a battery is something that stores energy. You and I are batteries, right? Like, again,
Yeah, right.
we can call it whatever we want. And there's lots of research out there. There's lots of SBIR money out there for it. There's lots of DOD money. There's lots of NASA money. Everybody's throwing money at it.
I just saw something in the news that said that who just tested using hydrogen storage? Let's see.
There's a company right here in Hammond researching plasma storage.
Oh, okay.
Yeah, these companies are all over.
They're trying to figure it out.
Yes, somebody's going to get there.
And whoever gets it,
It's a big deal.
they got money for
I'm gonna
years.
have to start working on that.
It's
then.
not years. That's,
Oh yeah, for
no, it's not decades. That's
that's ridiculous.
buy a planet money. Yeah.
Yeah.
Whoever figures that out, how to store energy better. So the best we can do right now is lithium, and we all hate it. And lithium stocks have been fantastic this past year. When you said, hasn't everything lost money? No. Nope.
That will be like commodity stocks then, right?
No, there's actual. No, they're no.
It'd be mining companies.
They're mining but lithium companies, right? So you
Okay.
can be a coal mining company. You can be. I mean, you can mine. Companies can mine a whole bunch of different stuff.
Yeah.
Lithium's process is unique because you do it through this water, and we have them in this country, and they're all over the world too. But it's a process, right? But everybody's putting batteries and stuff, so lithium companies are just crushing it right now.
I see.
And everyone needs a battery. There's a battery just about anything.
Figure it out, make it light, and make it easy to store energy. It's a game changer.
Let's figure it out, Nico.
I'm gonna do it. I'm
do
gonna
it.
do it.
You see what I'm saying,
Yeah.
though?
Yeah.
Oh,
Yeah.
and you have it right here too. This in Seoul, CB&D Storage Solutions, an American storage tank developer involved in the yada 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 yada. They did
Involved in the construction of the world's largest liquefied hydrogen tank at the Kennedy Space Center in
Yep.
Florida.
There's also another one in Arizona that's doing it with sand and solar panels to create plasma. They're all over. There's big money being thrown at this. Figure out how to store energy so you don't lose it once you create it, because we know how to create it. Solar, wind, hydrogen. We know how to create it. How do you store it so you can use it later? And I'm not talking about use it like a second later. I'm talking about solar energy right now. If we can do this building with solar. Absolutely. What happens at 7 p.m.?
Right, then you're out.
Yeah, you're done.
You
So
store it to a battery, and then the battery runs out,
Yeah.
and you have to do it again the next day.
Are you saying in regards to like how you said that when you transport it loses 30%? Are you saying in regards to that because when you store it loses you're losing energy.
Yeah. Did you have to plug in your phone today?
Yeah.
Yes.
Yeah.
Does it get less and less effective over time?
Yeah.
Yeah.
That's what's happened. Yeah.
Yes.
Okay.
Yes. Fix it.
Okay.
Fix it.
I will.
Thank you. Thank you. I'll be your first investor. Fix
Okay.
it.
All right, all
All
right.
right. I'll figure it out.
Well, we're going to take one more last break here on the Stock Talk, so make sure you come back here with Stock Talk with Josh and Nico. All right, we're back here at the Stock Talk with Josh and Nico, and before we end this episode, we want to ask AJ, for us being young, college students, that type of age bracket, what do you think we should be doing with our money?
Yeah, it's a great question. So, all of our young clients, what we want you doing is, if you're working, you need to be putting your money into a Roth. No matter what, it has to be going into a Roth. And the reason we say Roth is for several reasons. Is one, it's tax-free to you. The growth is tax-free. Yeah. 2, you can use it for home purchases. You talked about buying a home earlier, right? You can use it for home purchases. You can use it for some education expenses if you go to grad school. But you've had this pile then that's grown tax-free. Nobody else gets a tax-free pile. Nobody. The only way you get tax-free piles is a 529, a Roth, or certain types of insurance vehicles that you can do on an insurance chassis. That's the only way you get tax-free with your own Social Security number, right? You can get an EIN that can do tax-free. That's a different conversation. The best thing you could do is a Roth IRA, put as much as you can in it, and buy the index.
See, the thing, my problems with the Roth in the past has been like, one, so it's meant as a retirement thing, right? To take the money out when you're retired.
Or a home or education.
How does that work with a home?
You take out the money to buy a home.
Oh, and it's tax-free?
Yes.
So you can do that when you're 30?
Yes.
I told you,
Wow.
get a Roth.
I know. And the other thing is it's a
You told him?
I have a Roth.
Well, the other thing, too, is it's a $6,000 limit per year.
Yeah.
And, if I want to invest more than that.
Then do it. But start with the Roth.
Oh, you're saying put the first 6 in there.
Put
and
your
then...
first 6 into the Roth.
Then you just have money in there.
And so if I take money out, let's say 5 years from now, am I going to get...
House?
Yeah, let's say to buy a house. Am I going to get penalized?
No.
There's no penalty?
No.
They don't... Okay.
Okay.
Well, then you convinced me. Then.
We have been talking, even on the episode, you can go like in the past episode, we even talked about this.
Yeah, we have.
I told him to get one, but he looks at me crazy.
It's not crazy. You will not be able to participate in it forever. So you should be doing it now.
Okay, and so the Roth just means, like, I can still make that account through a Fidelity.
Sure.
And I can still buy stocks the exact same way I'm doing. Okay. Okay.
Yeah. It's just in a qualified account rather than a non-qualified account.
Okay.
Yeah.
Yeah, that's it.
Oh, you said like it won't like last forever. What do you mean by last forever?
Because you have income limits as to how much you can put into
Okay,
a Roth.
yeah.
You
Just like the
eventually,
six,
yes, you get, well, no. How much, you can't put money, if you're making $500,000 a year, you
you
cannot
can't do a
put
Roth.
$6,000 into a Roth. There's other ways we have to backdoor a Roth.
Oh, I didn't know that.
Yes, there's income limits as to your $6,000.
So
okay.
let's say if I have my Roth and I sell a stock, then I could take that money out and it's not going to get taxed?
What did you take it out for?
It has to be for
It has to be for a house?
educational.
Yeah, you could
home.
sell the stock and go buy a new stock. Keep it in the Roth.
And it won't get taxed?
No.
You don't? Okay.
No, there's no cap gains on it. There's no short term on it, long term. No, keep it in the Roth, and there's no taxability.
Okay.
Ever once you're retired, too. See, what we have happen now is imagine I told you for the past 20, let's say you're 50, and I tell you for the next 20 years to put money into your IRA and your 401k, and now you're 70 and retiring, and you have $1 million in your 401k and your IRAs, and that's your large asset.
Mm-hmm.
Do you know what happens when you start taking money out of it? It's taxed as ordinary income.
Yeah.
Roths won't be taxed ever
Okay.
once you take them out if you're 60 either.
Okay.
Okay.
So get $1 million in there, and now you have a tax-free pile of $1 million. So a tax-free pile of $1 million in a regular IRA, that's somewhere you've lost $250 to
Wow.
$300,000, depending on your tax status from other income.
Yeah, right. Wow, okay.
Compared to a Roth, you'll have all of it.
It's worth $250,000 to you.
Mm-hmm.
Do it.
Mm-hmm. See, the other thing I learned, I didn't know this till like 2 weeks ago, was that if you, for the dividends that are in your account, if you have them automatically reinvested, they don't get taxed.
Once you've owned something you get qualified dividends. You can get qualified dividends. If you're short-term trading, you have to deal with short-term gains and losses. If you're a long-term investor, it is much more tax beneficial to you. Now, if you're still making under $40,000 a year as a single person, none of that's taxable to you anyways. But
Oh, okay.
yeah, your first $40,000 of income is free to you. After that,
Okay.
yeah.
Okay.
But just pull up a tax
Are you
chart.
saying in regards to your stock gains, or are you saying just in general income?
Once you cross over 40,000 in general income, then you hit brackets for short-term and long-term gains.
I see. Okay.
Yeah.
Okay.
But pull up a tax. Every firm has a 2-page tax. Here's what the IRA limit is. Here's what the SEP limit is. Here's what the cap gains number is this year. Every year it changes.
Okay. Good to know.
Yeah.
Interesting. But besides that, Nico, you got any questions?
No.
Well, AJ, as the co-host of
Yes.
Stock Talk, I want to thank you for coming on to
My
episode 30, right?
30. Episode 30.
Episode 30 of the Stock Talk. But besides that, we have nothing else left here for this podcast. So y'all have a good one. Be safe. It's also, this episode should be coming out Tuesday, but I hope everyone enjoyed their holiday weekend. Always stay green.